Dryden Pence, the Chief Investment Officer of Pence Capital Management. Good to have you back, and thanks for joining us today. We rounded the halfway point here in 2026, and it was certainly a noisy one. But so far, so good. Seemingly, a big part of the first quarter was energy markets. A big part of the second quarter was energy markets, but it seems like things have started to normalize. What have you made of the price action through the first half of the year?
Well, obviously, price action first half year was driven by the instability and the problems with Iran. But I think what we're seeing is the fact that economics beats politics every time. And so now we're moving ships through the Straits of Hormuz. They're talking at least, and then they're fighting on the weekends. But the important thing is that we're beginning to see movement of oil through the Straits of Hormuz. That's going to begin to normalize this market. We've seen a dramatic fall in prices, and we think that that's probably a trend that's going to continue for a little while. And so I think that this is really going to be very helpful in the second half of the year, both taking out volatility, but also putting dollars back in the hands of the American consumer.
And so when you look at that second half of this year from where we're at right now, given everything you just said and more, does that give you confidence not only in maybe what might happen with oil or the Strait of Hormuz, for example, but just a broader equity exposure into the second half of 2026?
Yes, it does. And the reason why is really twofold. We have a lot of stimulus coming from excess withholdings from the Great Big Beautiful Bill, tax cuts, that's coming into the market. It's the equivalent of about $790 billion. Now you have oil coming down. And if you want to give the American public more dollars in their pocket, cut the price of gas, because people go to the gas station more than they go to the bank. And at $69 about right now, last time we were here, gas was about $3 a gallon. So the trajectory of gas prices is going to be down. That improves the American consumer. They're going to be spending that money elsewhere. So I think we're very positive on the back half of the year for those two major reasons.
And when you start thinking about those moves lower in oil prices, hopefully the subsequent, significant move lower in gas prices, and this new regime at the Federal Reserve under a Kevin Warsh-led Fed seemed like, and correct me if you saw it differently from his first press conference, but even some of his statements today, that it seems like he wants to establish a credibility that they get pricing under control so that he can make the sweeping reforms that he's laid out. Does the oil price normalizing get us there faster in your mind?
Absolutely. I mean, oil isn't all of the inflation story, but it's a lot of the immediate impact, and it impacts its way through the economy. So prices go up fast, they go down a little bit more slowly, but I think what we're going to see is oil coming under control is going to basically take that idea that the Fed needs to raise rates off the table because inflation is going to be taming out a little bit. And then it is going to give the Fed chairman some room at the end of the year to take a look at all of the reforms he wants to do. Good that he moves slow, but I think the data is going to be in his favor as we move forward.
You mentioned some fiscal stimulus, and that just hasn't been a discussion that's come up a ton. We know from the big beautiful bill there was larger tax refunds than there has been in recent years. So much of that was kind of offset at the same time by the rise in gas prices. How big of a role does fiscal play in the U.S. economy, right now and going forward, or was that kind of a first and second quarter story?
Well, no, I think it's actually a third and fourth quarter story. I mean, all of a sudden you had people that were going to have to pay in taxes, now don't have to. Basically payments turned into refunds. But I think you still have a lot of people that still haven't filed all their taxes. The larger tax returns go into the latter half of the year. Some people have until October. But more importantly, the rest of this stimulus from tax cuts will kind of be backloaded. And I think what you're going to see going into the back part of the year are two things going on. You're going to see an increase in corporate earnings, which is going to help drive the markets as companies are beginning to take advantage of AI, but also consumer sentiment should get better. and consumer pocketbooks should get better. So you have all of this. I mean, the stimulus, people forget. You have almost $790 billion worth of stimulus coming into this economy. That's almost the same amount of money that we dumped into the economy when we had COVID and everybody got a check just for breathing. And so when you put that into a functional economy that's highly stimulative, we think the back half of the year is going to show that.
Dryden, as we kind of tie this all together then, assuming there's no major setbacks, let's say geopolitically, which is a big if, but if oil prices kind of, stay where they're at or continue to move lower, is there still opportunities investing in the energy sector, especially given some of the AI demands for power?
Absolutely, and in terms of companies we like, and all of the energy sector is good to invest in because there's this tremendous long-term demand. But if you're also looking at oil and how that works, we like Exxon Mobil, we like Chevron. People don't realize just how big these companies are, and they're integrated oil companies. So even as the price of oil comes down, their margins are able to be very, very good, and they have large reserves. People don't realize that Exxon is really the 6th largest producer of oil in the world. It's bigger than Iran. It's bigger than Iraq. Chevron is bigger than Kuwait. And so when you think of those two companies and their dominance, they are able to make a lot of profits and do very, very well in the U.S. economy, somewhat insulated from some other areas, but it's really important that we like this segment. These prices have come down a little bit, and we think that this softness actually is something to buy into because this is going to be stimulative to the overall economy at large.
Really appreciate the time. Dryden Pence of Pence Capital Management. Always a pleasure and some great insight.